Hello, everyone. I'm Gayatri from Index One, and I'm joined by Chris McHeffey and Craig Camille from BX. Today, we'll be discussing what an effective tactical allocation strategy looks like and how it can be designed to optimize for risk. Tactical asset allocation is essentially about giving a portfolio some flexibility to adapt to what's happening in the markets. Instead of sticking rigidly to a long term allocation, investors make short to medium term shifts to take advantage of opportunities or to protect against risks. For example, you might lean more into equities during a strong bull market or move towards defensive assets if you see signs of a downturn ahead. Tactical asset allocation is less about picking individual stocks and more about reading the bigger picture around macroeconomic trends, market cycles, and sector movements. And if done well, it can help boost returns and manage risk, although it does require more active management, research, and the ability to make timely calls. It's a hands on approach, but one that can add real value to a portfolio. In this session, we'll discuss why incorporating tactical asset allocation strategies can strengthen portfolios, highlight the benefits from both a risk management and financial planning perspective, and introduce some of the models used by BX to construct tactical strategies calculated by Index One. This is an especially exciting webinar because not only will you be hearing from our familiar faces, but you'll also hear directly from the money managers who created the 5 models that we'll be discussing today. They will introduce their research and share their methodology on risk management and tactical asset allocation. Today, we'll be hearing from Brad Roth, CIO of Thor Funds, John Coulter, Managing Director of Trend Rating, Dan Snover, President of PMV Capital, Dr. Tal Schwartz, CIO of AI Funds, and Scott Wetherington from Adaptive Investments, who unfortunately couldn't make it today. We'll have time for questions after the presentation, so please feel free to submit your questions in the chat box as they come up. With that, Craig, why should financial advisors consider implementing tactical asset allocation models, and what is the best way to put them into practice?
The answer is that when we at BX, when we look back at the movement in the markets this year, that we believe that if and in other years, but this is a great year to look at 2025, if there's a way that we can minimize drawdowns when the market is in a downdraft, then that creates a much stronger principal position to be making money during an upswing. So, as we look at the strong move we've had for the last 4 or 5 months, our goal in having a tactical strategy is to mitigate the risk during the drawdown that we saw in late February and March and early April. At BX, we work closely with Index One. BX represents and works closely with 20 different money managers, of which a handful who are primarily on the call today are very good at doing research and identifying when is a good time to make asset allocation changes. At BX, we've created a model, which Chris and the rest of the team will go through in a second, which basically highlights the importance and financial benefit of lowering risk and not just being sort of all in all the time or making random asset allocation decisions. So I'm going to turn it over to Chris, who's going to walk you through the BX tactical model and then introduce some of the different managers that are on the call today that represent an important sleeve in the overall construction of the model.
Yeah, thanks, Craig. So what we endeavored to do was, we looked at our collection of, 65 curated strategies from around the world and saw that, roughly 11 of them are tactical to some degree, meaning they've got the ability to change their asset allocation or change their posture in reaction to whatever signals they're seeing in the marketplace. So what our investment team endeavored to do was to create a model portfolio that was a blend of a number of these different strategies that produced what we thought was kind of an optimal result. So what we did is what we always do when we look to create blended portfolios is we wanted to make sure the strategies fit together. We wanted to make sure they were lowly correlated to one another to get a diversification benefit. So the point of this portfolio is to give you a diversification benefit versus your kind of core holdings. So this is what I would call a long biased tactical model, meaning it's never going to slam on the brakes, but it certainly does take its foot off the gas from time to time. So what we wanted to do was create an outcome where you were able to derive equity-like returns, but had much lower standard deviation and maximum drawdowns. Because at the end of the day, clients hate nothing more than big drawdowns. So we wanted to create a portfolio that, in fact, kind of protected against that. So the sleeves that we chose all have very, very different methodologies for determining what their allocations are going to be. So that to us was exciting because, once again, another type of diversification benefit. So what you see when you look at the portfolio, and this is over I think it's an 8-year period from 2017 to the present, where the maximum drawdown on a full equity portfolio, say the Russell 3000 or the S&P 500, was about 35%. And the maximum drawdown on this model was 18. So that's a really substantial downside protection benefit, but you really didn't sacrifice anything in the way of returns. I mean, we're not here to advertise returns, but let's just say you were more than satisfied with the equity-like returns that you were seeking when you went into this model. And you can see, for example, the year 2022, almost no loss on this portfolio whatsoever. Remember, in 2022, even in the AGG, you had a massive drawdown, right? In the S&P, you had a substantial drawdown. But by mixing assets in this way, you were able to create a portfolio that we really didn't lose any money. And then you can see in the years since then, you've performed very, very well. So that's kind of an overview of what the portfolio is. But what we thought would be really interesting to the audience is not to talk about, BX's portfolio construction as much. This is the result of a lot of hard work between our whole team of sourcing all these strategies and then vetting them and doing the due diligence and then the hard work of the portfolio construction process. But now we'd like to do something we don't usually do on these webinars, which is talk to the manufacturers, the strategy creators of these different models that go into the portfolio, so you can hear what their secret sauce is and what they're thinking today. So G, maybe we can switch to the next slide. So first up, we're going to bring on Dan Snover of PMV Capital. The downside defender strategy is one of the components of this model. Dan, can you tell us a little bit about downside defender?
Yeah, sure, definitely. So the process at PMV Capital is to, as we've been discussing on this call, manage risk efficiently and also find opportunities regardless of what's going on in the market environment. So our process first starts with the investable universe, which, if you think about stocks and bonds and commodities, there's only a certain number of holdings within those asset classes that work well together and can give you upside potential in the various markets. So, for example, on the bond side, we think there's only really one type of bond that is a strong diversifier to stocks, which are long-term U.S. Treasuries. And the reason for that is when stocks are going down in a recession, you need something to be able to go up as much as stocks are going down. And so you actually are looking for the positions in your portfolio to have a similar risk profile or volatility. And so, on the bond side, we limit it to that exposure. And then on the commodities, we break it out between the broad commodities and also some gold exposure, which recently has been trending pretty strongly given the underlying macro environment. And so what we're looking to do at PMV is basically take advantage of the underlying trends that are created from the macroeconomic environment, and then balance the risk between the top trending assets such that no matter what's going on in the economy, you've got some asset, some opportunity. And then when you think about the risk management, what we're trying to do is maximize the diversification benefits that you can get in a multi-asset strategy.
Thanks, Dan. We appreciate that. We really like the the approach to allocating from time to time to these somewhat non-traditional asset classes that serve as a nice diversifier to the rest of kind of a traditional portfolio.
Right.
So, G, what's next? Okay, AI funds. Dr. Tal Schwartz, tell us a little bit about Bela.
Sure, happy to be here. So we've built our own proprietary AI system called Bela. Bela stands for Bayesian AI Learning Algorithm. And Bela does two roles. One is a macro strategist, and the other one is a portfolio manager. As a macro strategist, what Bela tries to do is look at the most recent patterns in different indicators and look for matches in the past 50 plus years, and see where the patterns match the best. Once it finds those best matches, it looks into the future to see what happened, then builds a distribution to try to figure out whether we're in a bullish environment or a bearish environment or somewhere in the middle. And that's what Bela does on the macro side, trying to figure out where is the market going. And then based on that prediction, as a portfolio manager, given its universe of assets, it tries to figure out what is the best combination of assets that minimizes the downside risk while maximizes upside risk. So it does a very sophisticated optimization and searches a very large space to figure out the best combination of assets that gives you that type of performance. And specifically for BX, we have a universe of over 90 different ETFs that it looks through and tries to figure out the right kind of combinations of ETFs that gives you exposure to different areas in the market. So it could be quite subtle, but overall gives you a very nice upside while minimizing the downside, given what it's predicting for the market. So it could be different levels of risk exposure in the market based on what the macro strategist side says, as well, and then adapt and have the right portfolio for that level of risk. Does that make sense?
Yeah, I think that's a great succinct explanation. Obviously, you can watch a much longer video to hear more gory detail.
Absolutely.
But how would you describe Bela's current posture on the market?
Oh, right now, Bela is very bullish. I would say it's been bullish for quite a few weeks. Essentially, it's looking at the patterns and seeing that although we are at all-time highs, the patterns indicate that there's a lot more to go from here. We run Bela on a weekly basis and a cadence, so we can tell whether there's a risk and the prediction horizon is somewhere between 1 and 4 weeks into the future. But really, we run it on a weekly basis so we can get that signal and see whether in the next week, whether there's a risk of a drawdown. And we define a drawdown at least 5% or more in the market. So small fluctuations are not going to make Bela go risk off, but if it's a large enough fluctuation, then it's a potential fluctuation, then it would mitigate risk and reduce that. So, but right now it's seeing that we are definitely in a bullish trend and likely to continue for at least 1 to 4 weeks as of this moment.
Thanks, Tal. Actually, before we go forward, G, I'm going to go back because I didn't get a chance to ask Dan what their models are kind of telling us about what they're seeing in the markets.
Yeah, so when you look at the trends of the various assets, we're seeing on the equity side strong trends in the international and emerging space, and commodities, really particularly gold. Treasuries are still seeing negative trends. And so when you add that all together, it seems like we're still in an environment where there's some concerns about economic growth, but inflation is still above target. And the underlying driver, a lot of this, I think, is a weakening dollar. And so right now we're seeing, again, a lot of the strongest trends in international, emerging, and physical gold.
Great. Thanks, Dan. Gee, what do we have? Okay. John Coulter, trend rating. Tell us a little bit about the Fantastic Five and the trend rating system that drives it. Now, this isn't a strategy that's tactical in the sense that it changes its asset allocation, but it can make very significant changes to its posture and the types of industries that it winds up gaining exposure to. So, John, tell us about the Fantastic Five.
Yeah, sure. Thanks, Chris. So, our model first, before I go into the specifics, is predicated upon trend capture. So, our research team looked at traditional academic momentum factor models, found them to be typically very late on entry and exit. So we came up with our own smart momentum model, as we call it. Within that model, there are 8 technical indicators with specific weights. And rating rates are generated from that A, B, C, or D. It's basically looking at the strength and the consistency and the magnitude of an underlying price trend. So within the technology platform that we offer, there's a very robust strategy builder and backtester. So for this particular strategy, what we did is we looked at all of the sector and industry and theme ETFs from iShares. We're basically rebalancing them on a quarterly basis, and we're taking the ones upon rebalance that are near the peak of the trend. So anything that falls below 3% under the peak of the trend gets eliminated from selection. And then we rank them in order of strength of the trend for 5 ETFs that are held in the portfolio, sector and industry ETFs, as I mentioned before. And of those, we're capping any particular sector or industry at 40%. So it's one of, I think, 4 different strategies that we offer, white labeled on BX. Anything that you see labeled trend capture is trend rating. From a macro perspective, Chris, if you look at all of the aggregate ratings for mid cap and large cap US over the last month, we've seen hardly any change in the percentage of positive ratings. It's gone from 65% A and B rated to 68% A and B rated. Typically, when the threshold falls below 40% of A and B ratings, more than for a 2-week period, it could be the sign of a correction. We saw this in the months leading into 2022. We saw it early this March. So right now, things look stable. If things start to, in aggregate, fall below that 40% threshold, could be sign of a correction.
Yeah, thanks, Sean. Appreciate that. Gee, we can, yep. Okay, Scott Wetherington is the CIO of Adaptive Investments, and unfortunately, he got called away on a last-minute something that he needed to do. But the growth value rotation 10 is a component within our tactical model. Once again, this is not tactical in as much as it changes its asset allocation. But what it does is Adaptive has developed a system that's used for many years where it leverages a number of different technical indicators and it puts them together. And it basically, the system will tell you whether it's more favorable for growth stocks or more favorable for value stocks at any given point in time. So that's a great indicator. It's got a great long-term track record. But what we did was we made it investable. So we created a product that leverages this indicator by allocating to one of our strategies that heavily favors growth stocks when it points to growth, which it's doing right now, and a different 10 stocks that are high dividend, high value, sleeves when the indicator points to value. So that's what the adaptive growth value rotation 10 is. I think that this is a really interesting indicator and something you might want to just subscribe to, because a lot of advisors know that there's value in deciding whether they should be in growth or value, but they have no idea when the right time to do it is. And Adaptive has a system that you can access to do it, and we've got a vehicle you can use to invest in it. And right now it's pointing very strongly towards growth stocks. So with that, we can move to Brad Roth of Thor. Thor has a number of different strategies on our platform. Most of them are tactical in nature in as much as they do change asset allocations. For this model, we chose to use the low volatility SDQ strategy. So Brad, can you tell us about SDQ?
Sure. I mean, the strategy of SDQ doesn't get too much or it's very simple, I guess is what I'm trying to say. It's not complicated at all. The SDQ stands for the S&P, the Dow, and the Qs, or the NASDAQ 100. We are either fully invested in those at equal weights, or we have algorithms behind the scenes that'll tell us whether or not we need to be shifting from growth or value and or get into short duration treasuries. And so we have a similar, I think, philosophy to John above it with trend rating, only instead of using technical indicators, we took more of an engineering and physics approach to really look at the overall cycle of the market. And I think as we started this call, I think it was you, Chris or Craig, said, clients don't like drawdowns. Well, we hate drawdowns at Thor. That is our number one mandate, to try and remove as much drawdown as we can out of a client's portfolio. And so this strategy has been live for over 6 years now. We've had 3 opportunities to show our worth in 2020, 2022, and then the first quarter of this year. And so far, we've done a good job of protecting client capital. The strategy is not meant to find additional alpha in bull markets. We simply just want to participate. And not to sound cliche, but the whole idea really is to win by not losing. And so, as far as a current stance, which I think you're going to ask me, Chris, we're fully long the market in all of our strategies. I don't think we've made a trade for 5 or 6 months. We've stayed pretty long the market. Like I said, we're looking for larger cycle changes, right? We're not going to be moving in and out of the market when it's moving 5, 6, 7%. We need to see some real slowdown in terms of the cycle in order for us to get risk off. But it is volatility dependent. It is cycle dependent. I could change my mind next week, like a lot of people on this call. So as of right now, all signs continue to point towards a continuation of the rally. And I think we all got a little bit of help from the Fed yesterday that'll help us a little bit as we move on into the next handful of months with a little bit easier monetary policy. So
that's great, Brad. Thank you, and thank you for sparing me the horrific burden of having to ask you how it was currently postured. Do you want to move on?
Yep, perfect. Thanks, Chris, and thanks everyone for your insights. Cool. So what exactly does Index One do in all of this? Oh, pardon. Index One serves as the index calculation provider for the BX strategies that we've discussed today. And as an index provider, we partner with advisors and investment strategists to bring innovative ideas to life across various themes, asset classes, and factors. By leveraging our ability to design and calculate indices that are tailored to specific objectives, we've helped drive the creation of differentiated allocation strategies that power both funds and model portfolios. The BX indices that we've covered in this session are among several indices we calculate for BX, which are then combined into index blends to meet a range of client investment goals. We're pleased to play a role in bringing these strategies to market, helping advisors support their clients' financial objectives more efficiently while continuing to foster innovation in indexing strategies. All the BX models that we've discussed in today's session are available on both the BX and Index One websites, as well as the Money Manager's websites. If you have a strategy you'd like calculated in real time or as an index and potentially integrated into other portfolios, please feel free to reach out to us. We're now moving into the Q&A portion of the webinar. Please feel free to submit your questions in the chat box and we'll address them as they come in. I don't think we have any questions as of yet.
I might just sort of ask a question or make a comment as we're seeing if there's any other questions coming in. It's really interesting when you look at the global macro and economic outlook and valuations and the Fed and tariffs, et cetera. It just feels, I think, to many investors out there that there's a lot of risk in the market. And what we're trying to do is eliminate some of that emotional fear and put more power in the hands of financial advisors so they can moderate the risk in a portfolio. It was really interesting listening to the description of the 5 strategies and strategists who we think all do a great job individually. And I think you can feel the power of the blending together, but they're all fully risk on at the moment. And if we collectively added up the posture on a scale of 1 to 10, it would be just under a 10. And what we think is really powerful about the tactical model is it's kind of an alert system to say, hey, maybe now is the time to be decreasing risk. So it's just really interesting. It's a really interesting time to look at it from the sense of where are the markets, where's the economy, but also where these 5 great strategies, and they're currently in a risk on state pretty aggressively. The other thing I would say is, the tactical model is sort of an equal weight of 5 sleeves, and it's a really interesting multi-strat. However, each of these sleeves can be bought individually, and BX and Index One can also customize the strategy for a user that may include exactly the way we built it, or can be adjusted based on what a firm or a financial advisor is doing with the rest of their core portfolio. So G, I'll turn it back over to you, and thanks for hosting this webinar.
Thanks, Craig. Perfect. We've got a feedback and a question from Badami. Very interesting, so much to learn on this. Thank you very much. And the question is, does market cap weighting really the best way to weight an index? Does anybody want to?
Well, I'll just say
Sure.
I'm going to let our panelists answer this from, maybe a more academic perspective, but, the team at BX doesn't really believe so. Most of our indexes are designed specifically to outperform cap-weighted indices of, various types. We do think it's possible to do so, and to do so over time with the right systems. We just think that you need to have the skill to develop a systematic approach that develops an index that is better than a cap-weighted index. And we do believe there could come a time where, cap-weighted indices significantly underperform other types of strategies like equal weights or systematically derived strategies. But who on the panel wants to take a crack at this?
I'd love to take a crack at it. So I would say that capitalization weighted is the right weighting if you believe the markets are perfectly efficient, meaning that all information is reflected in asset prices. In that situation, yes, cap weighting makes a lot of sense, and that's the academic way of looking at things. But if you believe markets are not perfectly efficient, and there's opportunities to do better than what everyone else thinks, then obviously there are going to be other weightings that are going to do better. And as we know, historically speaking, markets are not really, at least that's my belief, working for many years in financial industry and hedge funds, there's many other, a lot of signals in the market that you can use to do better than just cap weighting. And in the long run, you could do much better by actually looking at signals and figuring out other weighting schemes. And I believe that there's better ways to optimize a portfolio than just cap weighted, especially if you're looking at downside risk, which is an asymmetric type of distribution. When you do that, then cap weighting definitely is not the best way to optimize a portfolio.
Thanks, Tal.
Okay, awesome. Yeah, thanks, Tal, and thanks, Chris. Cool. I think those were all the questions that we have gotten today. If anyone else has any questions, please feel free to reach out to us via our website or email addresses. Cool. I guess we'll wrap it up then. Thank you, everyone, so much for your time and participation. And thank you to our panelists, and as always, Chris and Craig. Be sure to subscribe to our email newsletters to stay updated on our next video content. In the meantime, thank you all for tuning in, and we look forward to seeing you next time. Thanks, everyone.
Thanks all.
Thank you.